Charitable giving. Today we're going to dig into some of the more commonly used techniques here at 10 Capital when it comes to giving to those entities that you care about. So if you missed our Lunch and Learn that we held here recently with Inovia, I want to give you some of the key takeaways that I spoke about. Some of the more commonly used techniques that we implement on an annual basis so that the most amount of money gets to those charities that you care about and the least amount goes to the government. But first off, I want to talk about what the title of the weekly commentary is today, and that's A Giver's Heart, Charitable Giving. A client and friend of the firm brought up something really great that I want to touch on before we jump into some of the techniques, and that is really the heart behind the gift. And I think that's an important thing because at the end of the day, we can save on taxes, but it's not necessarily what the motive behind the gift should be. So I think at the end of the day, keep in mind that any gift that you give to charity or any legacy that you plan on leaving is not going to be financially motivated. But if your intent is to leave a legacy, which is one of the more commonly heard of things here at 10 Capital when we're going through financial planning, then some of these techniques are going to be pertinent to you. First and foremost, let's talk about financial planning, because in everything we do here at 10 Capital, the foundation is built upon your personalized financial plan. And one of the more common goals that comes out of financial planning is that card, leave a legacy, or educate those I care about, or support others that I care about, right? And that can be family, it can be friends, or it can be charitable entities that you care about. Today, we're going to focus more on the charitable entity side, nonprofits, 501c3s that qualify for tax deductions. And the first thing we're going to talk about is called qualified charitable distributions, QCDs. Some of you might use these, some of you might be, what the heck is a QCD? Let's dig into it a little more. If you are currently having to take RMDs off your IRA, RMD is a required minimum distribution. It just got changed again from age 72 to age 73 or age 75, depending on where your age falls. But if you qualify for RMDs, you're at the age that qualifies for RMDs, and the government says you need to take X amount of money off your IRA every year by the end of the year, and you give charitably, this might be a great technique for you to utilize. How this works is you actually designate the charity that you would like to give to, and either 10 Capital can process a check for you directly out of your IRA to that entity, or we can give you checks to write off of your own personal account to that particular charitable entity. So any money that you give to them is going to come directly from your IRA to that nonprofit. And then at the end of the year, you're going to file on your 1040, your individual tax return, you're going to file as making X amount of dollars of charitable distributions to this entity and having elected the QCD, qualified charitable distribution, as the technique that you utilized. Why you would do this is because whenever you elect QCD, that actually goes against your RMD. So you can reduce your RMD amount and have it directly lower your taxable income by electing QCD. The other benefit is this actually allows you to still take the standard deduction because it's not going to be an itemized line item on your 1040. So this is a massive benefit and one that I recommend looking at if you're charity inclined. The second and last item that I'm going to touch on today, just for the sake of time and so you don't fall asleep as I'm talking about this, is going to be gifting appreciated stock positions. So if you were lucky enough to buy, let's say, Microsoft in the late 80s, and it has now a massive amount of unrealized gain in that particular stock position, which actually we ran across it more often than you would think. Clients get to a point where they don't want to have to pay the tax on it, but they might be charity inclined. And if they're charitably inclined, they can gift that appreciated stock position directly to a charity and get the benefit of the full market value of the gift. So let's say you bought Microsoft for $5,000. It's now worth $100,000 and you have $95,000 in unrealized capital gains and you have to pay tax on it at 15, 20%. Well, I don't want to do that. I don't want to pay the tax. Okay, but I do want to make a gift to a charity. You can get the benefit of writing off a $100,000 gift to a charity by giving them the appreciated stock position. They, being a not-for-profit, can go and sell that appreciated stock and not pay the capital gains tax. And you also don't have to pay the delta of the unrealized between your 5 and your 100, your 95,000 in unrealized capital gains. A spectacular technique to use if you have appreciated stock positions and you are charitably inclined and you might not want to have to pay the income tax on it, the capital gains tax. If you want to dig into this anymore about what might be best with your financial plan, feel free to reach out to us here at 10 Capital. We're happy to run through some of these techniques, be it QCDs from your RMDs, a lot of acronyms right there, or gifting of appreciated stock positions if that applies to you. Until next time, we'll see you later. Have a great weekend.